money.
All right, Keelan. So a few weeks ago, you had 4 legs, and then you were down to 3 legs, and now you're back to 2 legs. Tell us a little bit about how you're feeling.
Yeah,
that was a hard road.
And when you're in that position too, it feels like you're going to be there forever. Like nothing's going to change. I'm just going to be, and everything in life you kind of take for granted. All the little things that you have this extra layer of not only the pain, but just like anything, like just getting up for things. And
well, it was nice having all the girls helping you out, though, right?
Yeah, a little bit. But you know me, I'm super independent, and I don't like to depend on other people. So you just feel helpless and all that. But in the retrospect of things, I mean, it went by actually pretty quick. Here I am, no more crutches. I'm walking around on the path to recovery, and I only have, 10 more months before I can play soccer again. But I'm really excited about it. I feel just great, and getting rid of that crutch is like a milestone for me. Yeah. So I'm feeling like, okay, I'm back. I'm ready.
There's nothing else to give you a hard time about. It's kind of sad.
You can always make fun of me for something.
I know.
Tina.
We're always trying to find something.
But that's why we love you.
Yeah. Well, thank you. I love you too. Well, that was great. Money Chat to hear a little update, because it was kind of a rocky road there for a while with the blood clot and all that stuff that came up that was unexpected. So glad to see that you are back and recovered.
I didn't die. That's good for my
goodness.
Blood clot. So.
That would have been bad. That would have been bad. I don't want to interview someone else as my co-host.
Oh, that's nice to know.
Yeah. So that's a little bit about Keelan, what he's bringing from Money Chat today. And I just thought I'd talk a little bit about interest rates, because it is really, really a hot topic right now. And the central bank announced that it's taking down the benchmark overnight lending rate to a target rate of 1.75 from 2%. Now, the previous range was 2% to 2.25%. This is the rate at which banks and other depository institutes lend money to each other, usually an overnight basis, as it's known as the Fed funds rate. How it's used is like the federal discount rate, and this is the rate that the banks are borrowing directly from the Federal Reserve Bank. But the federal funds rate is used to control the supply and available funds. Now, recession fears and rising during the summer among the heights of U.S.-China trade tensions weakened data, particularly in the manufacturing sector, the progressively rocky global economy. However, the data has firmed up recently that the Fed chairman, Powell, has held to his position that while the central bank will do what is needed to maintain the recovery, his views these cuts as a mid-cycle adjustment and not just part of the more aggressive strategy to drive rates lower. Now, the committee cited the implications of global developments for the economic outlook, as well as muted inflation pressures, as the primary rationale for the cut. Now, how does the Fed funds rate affect the U.S. prime rate? Well, it's directly tied. So the calculation is generally determined by adding 3% to the current federal funds rate. So the current federal funds rate right now is 2.25. So if you add 3%, that means that the prime rate is at 5.25. So if the federal funds rate, again, which is the rate that determines the cost for banks borrowing from each other overnight, then the prime is directly going to follow that. Again, the calculation is typically 3% in addition to that. Now, the Fed's primary role is to manage inflation and maintain a balanced market. So if the economy is moving too quickly, the Fed funds rate will increasing the prime rate, increasing the cost for consumers to borrow money for short-term loans. Again, as a reminder, what the prime affects is short-term. So that is home equity line of credits, it's car loans, definitely your credit card loans. What it does not affect is mortgage interest rates. So I want to take a couple minutes to talk about that, because it is a confusion with majority of consumers and even some people that are in the industry. Hear that the feds are lowering the Fed's fund rate, which is going to lower the prime rate, and think mortgage rates are going down. If you just look online and you can look at the difference between the prime rate, U.S. prime rate, versus the Fannie Mae 30-year or the 30-year interest rate, and you'll be able to see how drastically those two can actually differ. And it's actually what's happening right now as well, because the prime is going to be going down. But we've seen, even with that news in what the feds are doing, mortgage rates have actually seen a little bit of increase. Not much, but last week I would have told you the interest rate was 3.5% for historical rates, not quoting interest rates, because is. That depends on a lot of factors, so I need to disclose that. But today we'd be talking about maybe closer to 3.75% interest rate as the standard par interest rate for the average interest rate. So just a little bit about what's happening with the feds and how it's affecting the prime rate, but not directly tied to mortgage rates. A call to action: if you have not refinanced, pick up the phone, call the show at 1-855-400-1150 or go online to themoneyhour.com. If you have not purchased a home yet and you've been thinking about purchasing, sitting on the fence, get off the fence and get into the market. We've got a real estate expert we're actually going to be talking about when we come back from break. And speaking of that, next we have Eastside Housing Market, Sandy Tampa of Windermere Real Estate East, right here on 1150 AM KKNW after this short break.